Welcome to SB Talks. Today is Thursday, May 28th. My name is Vincent O'Neill and I am joined by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, Nick and I today will be running through a bumper SpaceX IPO discussion, US earnings season and the latest from Nvidia, as well as important Australian data shaping the interest rate outlook from here. I'd like to welcome you, our listeners, for another SB Talks. The last couple of years have been probably a somewhat quieter period for IPOs, but that could be all about to change. Rumors of Anthropic, OpenAI coming down the track, but the headline show in town is Elon Musk's SpaceX targeting a whopping 1.75 to 2 trillion IPO in the weeks ahead. What's your thoughts?
It's...
Are you a buyer?
No,
Okay.
not a buyer. I mean, it has all the hallmarks of a sort of top of the market IPO. This is a company that generated around $19 billion in revenue last year and lost about $5 billion. So it's a loss maker.
So let's just pause on those numbers. 19 billion in revenue and obviously still not profitable. How do we get to that valuation?
Well, it's really just all about hopes and dreams. You know, they sell a vision of colonizing Mars with 1 million inhabitants. They talk about a total addressable market for their products of, I think, $28 trillion, which is approximately the size of the United States economy. So there's a lot of sort of, I guess, moonshots in the prospectus.
For the benefit of the listeners, what are their core businesses in terms of revenue lines?
So
We'd be familiar with them somewhat.
Yeah, so there's the Starlink satellite internet service, which accounts for about 70% of their revenue, and that's actually a pretty good business. It's grown from, I think, 2.3 million subscribers a few years ago to about 10 million subscribers. It's in 164 countries. So it's a good business.
10 million's a lot of people, but if you think about the markets that they're in, that could potentially have material upside.
Yeah, but its growth has slowed, and its average revenue per user has also come down.
Right.
So it's a good business, but is it growing at a rapid clip still?
Yeah.
Probably not to the same extent that it was when it was a smaller business. So that's about 70% of the business. There's also the business called X, formerly known as Twitter, which generates some revenue from advertising. There's Grok, which is their version of their sort of ChatGPT.
Their AI tool.
Which I don't think generates much money, but potentially there's some revenue there.
And some value attributed to that.
And they're also now leasing out their Colossus data center GPUs to Anthropic for $1.25 billion a month. Obviously Claude has been incredibly popular as a LLM, and they need as much data center capacity as they can get. So they've done a deal with XAI to use their data center and chips. But that's a contract that can be cancelled at 90 days notice.
So there's probably several strands of AI flavor in this.
Yes, and then there's their rocket service.
So, for example, taking astronauts to the International Space Station.
So they get paid by NASA and
other
commercial
satellite launches
for that as well. So it's a part of the business.
Albeit a very capital-intensive business that they operate. And we talked about that valuation, 1.75 plus trillion. How much capital are they actually seeking to raise?
So they're looking to raise 75 billion, which will be quite a small percentage of the total value of the company, about 5%. So it will be fairly illiquid. But the NASDAQ have created this accelerated index inclusion, which will allow for the company to be added to the NASDAQ 100 index 15 days after it floats, which is pretty quick.
That's very significant. Let's talk about that because we know a huge portion of the world money sits in ETFs these days, and these ETFs will go and buy the main indices, the NASDAQ 100 being a perfect such example. So that's going to create, I guess, a pent-up buy demand as those indexes need to start purchasing the relative proportion of the stock.
That's right. I don't think it gets a full weighting for the full 1.75 trillion. I think it's 3 times the IPO value or something like that. But yes, there will definitely be quite a lot of demand, and SpaceX is trying to play into that by allowing existing shareholders to sort of progressively sell stock over the first 180 days. Normally, the stock is locked up.
Yes.
But this time they're allowing it to be progressively sold, really from, I think, the release of the Q2 earnings report onwards. So
to create a bit of liquidity
to
there.
create some liquidity, it is conditional upon the share price being above certain levels. But yeah, they're certainly playing into that sort of index inclusion, ETF buying theme.
And there's a slightly broader theme on this as well. When we think about, as I touched on before, there is the possibility or the rumors that the likes of OpenAI then eventually begin to go down from private markets to the public markets route, Anthropic behind them, which is sort of steaming ahead in its growth and its development. And then what ultimately the broader index looks like at the end of this exercise, because we know we already have a significant concentration in terms of names and tech names. This is only going to further, I guess, exacerbate that situation.
Yeah, I think I saw somewhere that the top 10 stocks in the US could account for 50% if those companies are included.
Of the S&P 500.
Of the S&P 500. Yeah. Now, the S&P 500 is stricter about including some of these new IPOs. And they've got a sort of a thing at the moment. So one of the things they didn't like is loss-making companies being included. They don't like dual classes of stock. Now, in the case of SpaceX, Elon Musk will control 85% of the voting control of SpaceX, even though his economic ownership is a lot lower because they've got 2 classes of stock. So the S&P is not really that comfortable with that. But they're doing a sort of review at the moment as to whether they weaken some of those rules.
Whether there's a compromise incoming.
Yeah. So we just have to see. But yeah, potentially 50% could be in the top 10 stocks, which would make it actually quite similar to the Australian market, where the top 10 stocks account for 50%.
Maybe your top
index.
10 names aren't quite as sexy as the top 10 on the S&P 500.
But there'll be definitely a heavy AI theme in the US.
And I must ask you then, from an investment perspective, like any investor, you're going to have a very healthy allocation to international shares. It will have been a tremendous place to be invested over the last several years. Does that give you any increased degree of caution?
I think you do have to be careful about the degree to which your portfolio is becoming increasingly exposed to AI. US equity market, but now even emerging markets. A quarter of that is in 3 stocks, TSMC, Samsung, and SK Hynix that all make chips that are being used for AI. So increasingly, the emerging markets, US market, credit markets as well, to fund a lot of this data center. So there's a whole lot of AI that's sort of trickling into public equity markets and credit markets that we just have to be aware of. And that's why, to some extent, we still have a decent allocation of Australian equities, which is banks and miners, to kind of
as well as the
bit.
important role of some of those other asset classes. We talked fixed income on the last podcast, but the other, I guess, what would be classified broadly as the alternatives.
And infrastructure and property and things like that.
Have an important role to play. And I guess that's important to reiterate, because in the last couple of years, when international equities have been as strong as they have, and it feels like, well, there's only one show in town and perhaps we should have all our money there. Now, probably increasingly so, just worth having a measured approach to how you allocate.
Yeah, there's a lot of debate at the moment. People saying it's a bubble, but then the strategist Ed Yardeni, who's quite well known, called it FEMO. So we've heard of the FOMO trade, fear of missing out. He calls it FEMO, fabulous earnings momentum.
Right.
So he's suggesting... I think that's momentum.
Momentum. Okay, I didn't get that. Sorry.
Yeah. So I think it's, and when we look at the Q1 earnings in the US, really strong. So just under 12% revenue growth over the year. 87% of companies beat earnings, and earnings were around 30% excluding the energy sector. Really strong earnings. So that's what's pushing the market higher. Now, a lot of that is in these hyperscalers that have, we've discussed. and we can quickly chat about Nvidia,
Yes.
which is sort of the poster child. You know,
Has reported since we last recorded.
it did, and its earnings $1.87 versus 176 expected, but that is up 95% over the same quarter a year ago. So just really strong earnings.
Almost doubled year on year over the quarter. Yeah.
So yeah, just very strong, you know, growth in that sector for the time being. And you know, how long does it last? We're not sure.
Yeah, and I guess that goes to important point to layer on that prior discussion we had. So I said, okay, well, if we have fears that some of these valuations and some of these organizations might be pretty toppy in terms of where they're at, it would be a very brave call to be massively out of the market still, because you know this show has probably got plenty more to run.
Yeah, particularly companies like that. SpaceX, I'm not so sure.
Yeah, yeah, not top of the.
100 times revenue. Yeah.
Perfect. Now, maybe we've had since we last recorded a couple of important bits of data closer to home. A lot of the attention in Australia this year has been about the RBA reversing the rate cuts of last year, but you know, where are we seeing things economically, particularly across key areas like unemployment and inflation, with some new numbers there?
So we had a bit of a surprise employment report last week, the loss of 18,600 jobs. That was below the 15,000 new jobs that people thought would be created. So partly, you know, that was a loss of full-time jobs as well. So it was a bit of a soft result, and that saw the unemployment rate go from 4.3 to 4.5. So that's above kind of where the RBA had been forecasting it. So that was a soft result, and that really saw markets sort of start to price out some of those rate hikes that had been built into money markets.
So if we go back several weeks, the markets had been expecting maybe even as much as close to 2 further hikes.
Yeah.
Where are we at now?
Yeah, so now we're just under 1 hike by year end. So not even a full hike priced. And we also got the April CPI data yesterday. Headline, you know, it's still pretty high. So it was 4.2% year on year. Market had been looking for 4.4. Food prices didn't go up as much as the analysts had forecast. But that's still too high. And trim mean inflation, 3.4% year on year, so well above the 2.5% RBA mid-target. So inflation kind of roughly where the RBA had forecast, unemployment a little softer. And we got the minutes of the last RBA meeting that said that they felt like there was sufficient space, I think was the term they used, to kind of sit back and watch what happens. You know, so they've done the 3 hikes in a row, and now I think there's no pressure on them to do anything.
Yeah, I think they, as you said, they've bought themselves the space to now use your favorite term, the old data dependent. Let's see how it flows. But there's definitely some reads there that are saying that maybe the rate rises and the expectation of more rate rises is having some impact. Let's give it more time to see how it plays out, and probably I think there's many parts of the Australian economy would welcome a breather from any more rate cuts in the short term, at least.
Rate hikes.
Sorry, rate hikes. Yeah, no, rate cuts. The Iranian situation, I'm almost lethargic to go back there. The more it changes, it stays the same. Discussion of deals about deals. It just doesn't feel like we've got anything dramatically more concrete except this relative optimism that there's going to be some form of exit without any substance to it.
Yeah, I mean, it's not even clear that they're talking to each other, because you had the Iranians come out and say, oh, you know, there's a draft memorandum of understanding, which is sort of a prelude to negotiating the peace deal, which would see the strait reopen and shipping kind of return to
mines cleared. And
you know, but they also said there were mechanisms with Iran and Oman where they would still control that. And no mention of nuclear materials or anything, or uranium or anything like that. So, and then
that was potentially going to be in part 2 of the deal. So just pushing out the most sensitive part.
But then Donald Trump has suggested that no, I'm not in any hurry. I'm not worried about the midterm elections. Oman, he almost threatened Oman if they were, you know, not
to do a side deal.
He wants to see the strait open, freedom of navigation, none of this control by 2 countries over the strait. So then the Iranians kind of backed away from that, and So we're not really anywhere.
Equity markets sort of largely ignoring the situation, and certainly in terms of the US.
Yeah.
Commodity markets, obviously oil prices do
so-
have a reaction.
Yeah, oil prices come down about $10. So it's sitting at around $95 a barrel at the moment. So it seems to be, still in that sort of glass half full, optimistic that a deal will be done camp. I mean, certainly there's all the talk on both sides is they want to do a deal, but there just doesn't seem to be any meeting of the minds so far.
They're just still pretty far apart.
Yeah.
Okay, a wonderful overview. Quick recap on where we sit across the world as we rapidly wind our way into our end of financial year. Thank you very much, as always, Nick. And thank you very much to all our listeners.